Well, ladies and gentlemen, here we are, 10th of February, on a day that we were meant to be meeting in person. My good friend, Mr. Rick Rule, investor and speculator, founder of Rule Investment Media, has been very kind to give us his time today to help us try and understand and make sense of what is going on at the moment. Rick Rule, thank you so much once again for joining us from your home in Washington. Once again, here we are on Zoom. Forgive my voice a little bit. I have the dreaded C, but isn't it lucky we're virtually meeting?
I think that's correct. I will greet the passing of COVID as sort of a mixed blessing. I love coming down to Australia to visit you all, but I hate the process of getting there. I hate Transportation Safety Administration. This is off color for your conference, Kerry, but I have two fake hips and I'm sick of being fondled by strange men at airports around the world. So the fact that I can do that over Zoom is nice. The only thing is I miss having a glass of spirituous beverage with you afterwards.
Which would be nice. And before we get stuck in, because one of the things I want to talk to you to help us understand today is make sense of what's going on. But before we do, we just mentioned that we're on Zoom today. We here in Australia are going to be doing an in-person event in June, but you've also got a conference I think in July, which is also in person. So it sounds like towards the mid to second half of the year, perhaps we will be able to share a drink.
I look forward to that. You know, we were live for 26 straight years in Vancouver before COVID got in the way. I don't want to trust the vagaries of both the US and the Canadian government. So this year, our live conference will be on the US side of the border, Oceanside in Boca Raton, Florida, which I'm looking forward to. Like yourself, Kerry, our attendees really tell us what to do with the conference. And we polled them and 80% said they wanted to come back face to face. So
yeah, I think there's, right. Yeah, Rick, I think that there is a real a feeling that we want to get back together. We are social beings after all. Before we get stuck in, if people want to find out a little bit more about your conference, where can they go to find out about it?
I don't have a website up yet, so they can email me, rick@ruleinvestmentmedia.com. And yep, it comes right straight to me.
There you go, ladies and gentlemen. Now you've got his personal email. Now, don't inundate him with ridiculous comments because he's a busy guy. Let's get stuck into it, Rick. Appreciate your time. Let's get into helping our audience understand what's really going on. I mean, we've had about 40 years of benign economic conditions. It seems to me that people are they a little bit lax? Are they ignoring the warning signs? What are you seeing in this current market? Because to me, I'm thinking no one's really sitting up and taking notice at the moment because they're comfortable. Are we too comfortable?
You know, Kerry, I have two comments to that. The first is when people say to me, Rick, when's gold and silver going to move? I say 3 years ago. Look at the price compared to where it was 3 years ago. It's already moved. People are conditioned to larger moves and they're conditioned to stair steps to heaven. And people need to learn to substitute what they want for what they can have. Moving on to your question, I think that people's perceptions of the future are shaped by recency bias. And the last 40 years, as you suggest, have been very benign, a period where we benefited from declining interest rates for 40 straight years, which meant lower cost of capital, higher bond prices, all that kind of thing. But we also benefited from restrained growth of government compared to the period before that. Maybe not for the last 10 years, but certainly for the 30 years before that. I'm not trying to say that government didn't grow, it just grew at a less robust rate than it had in the 50s and 60s.
Wow. We
benefited from increased trade worldwide. Now, some people don't like increased trade because it threatens their own livelihood in home markets, but it certainly makes everybody richer. And we benefited too from reduced international tensions. I think, you know, the Cold War is an example, US versus Russia, all that kind of stuff. I think when you look at where we are today, what you'll see is that although I don't want people to run and hide under their desks in terror, that benign 40 years is over. It's very difficult to take interest rates below zero. Negative real interest rates don't last because if that happens, you get no savings whatsoever, a circumstance which we're coming into. I think, too, that at least in the United States, the idea of restrained government growth was over 10 years ago. And government growth, the growth of government, is returning in earnest, which, while it may be good for government, is not good for you and I. We're seeing increased nationalistic tendencies and a reduction in international trade. Witness, as an example, your country's new relations with China, which serves to make people in both countries poorer. And I would suggest, too, that we may be nearing the end of reduced international tensions, the realpolitik around the Chinese bloc, problems with the Russians. One would suggest that perhaps the benign period in every regard that we've enjoyed in the last 40 years is closer to the end than to the beginning. As it relates to gold, what's particularly important is the trend in interest rates. A circumstance where interest rates go down at the same time that confidence in the currency stays up is the worst of all possible worlds for gold. But one wonders how far below zero interest rates can go. In my experience, Kerry, as I've told your audience before, precious metals move primarily because people are concerned about the purchasing power of their savings, denominated in conventional instruments. And nothing could make people more concerned about the purchasing power of their savings than a negative real interest rate. I've bored Australian audiences with this before, but I have to do it again because it's a number I know. The US 10-year interest rate is 1.6%.
Okay.
In a currency that the US government acknowledges is declining in purchasing power by 6.5%. So the arithmetic is simple. Take 1.6 minus 6.5. The US government is guaranteeing that they're going to cost you almost 5% of your purchasing power a year for 10 years.
Which is closer to 60%.
This will take its toll, and people will come to understand this, and people will come to be, at the very least, concerned about the purchasing power of their savings denominated in conventional instruments. But we'll get back to that later. I interrupted you.
No. What I was going to say, Rick, was you talked earlier about that government is not growing.
What I said was the last 40 years, beginning in the United States with the Reagan years, saw a reduced rate of government growth. Government never stopped growing, but government's share of GDP for 25 or 30 of the last 40 years was lower than it had been in previous parts of time. Government not grow only in my fondest dreams. But it turns out that we are individually tenacious enough and intelligent enough that our individual accomplishments can often fund our collective stupidity. And that's what happened in the United States. You have these young geniuses that get together, commandeer a garage in Sunnyvale, California. Out pops Apple, out pops Google. The truth is that these young geniuses generated enough utility for society that we were able to fund our collective stupidity, because our stupidity, that's a long way of saying our government, consumed a relatively smaller part of GDP that it had in the past. And the growth in stupidity, government, was also less voracious than it had been in the past. But that's over now. I think COVID has been, as an example, a wonderful excuse for voters and governments around the world to throw caution to the wind.
And grow and throw money at everything. And people are getting very used to the government's got my back. And if I can't work, they'll give me some money. Are we heading into more of a totalitarian regime where, for example, who cares about gold or silver? The government's got my back.
Well, that's probably the first part of the question above my pay grade, but I certainly believe that there's a complacency on the part of the citizenry, people perhaps with not much sense of history, to believe that the government has their back. But you know, this is not the first time in my career I've seen this, Kerry. When I was a very young man, actually for part of the time I was an adolescent, I remember reasonably well the period 1967 to 1973. In the United States, we had the hubris to decide that we could win the war in Vietnam, which we didn't, and we could win the war against poverty, which we didn't. But the consequence of fighting those twin wars meant that we had very, very, very high deficits, and it was politically inexpedient for us to raise taxes. And the consequence of that was that we debased the US dollar. It took 6 years of that bad arithmetic, the period 1967 to 1973, before the citizenry stood up and took note and began to sell their bonds, began to look for savings instruments that paid better than passbook savings, and importantly, bought gold. When the narrative took hold in the period 1973 to 1980, 1981, of course, the gold price advanced from $100 an ounce to $850 an ounce. But it's interesting to note that it took 6 years of high inflation and negative real interest rates before people shook off the benign aspects of the boom in the 1950s and 60s. I'm going to suggest to you, Kerry, that it's very likely that the benign period that we've lived through for the last 40 years has people shaking off the same obvious arithmetic now that they shook off then.
But do you think it's a little bit like, this time it's different? Do you think potentially this time it's different because we are living in different times for a couple of reasons? One, we have had the dreaded C word, and we've also got governments printing the funny money, or as you've often said in the past, I think you call it fraud or other aspects of it. It's different, isn't it? That didn't happen. Those things went around. So
I think it is different, Kerry. I think it's worse.
Oh.
You're right. Government didn't print then. In this country, as an example, apparently 35% of all the US dollars in circulation have been newly created in the last 30 months.
It's amazing.
It's not as though the US economy has grown by 35% in the last 30 months. It's that they have printed 35% of all the currency that's ever been issued in the United States in the last 30 months. Governments never dreamed that they could get away with fraud on this scale. And so, yes, I think it is different this time, Kerry. I think it's worse. At that point in time, which is to say 1967, we were terrified of the fact that aggregate government debt was 35 or 40% of GDP. Now government debt, on balance sheet government debt, is well over 100% of GDP. Mm-hmm. And the off-balance, and again, I'm talking about the United States, not Australia.
Sure.
The off-balance sheet liabilities of the United States, the net present value of entitlements. Look at me, a 69-year-old, Medicare, Medicaid, Social Security. The cost of old folks, as an example, is almost 5 times GDP. The off-balance sheet liabilities of the US government are now believed to exceed $150 trillion on a net present value basis. So yes, Kerry, things are different. They're not as good.
But they're not as good, but are people waking up to this, Rick? Seriously, do they actually believe that the inflation narrative? Because I guess, Rick, the question I have for you is, it's the wealth effect, isn't it? Property prices going up, stock prices going up. Everybody feels a lot more wealthy, apart from those young ones that can't get into the market in the first place. It's us baby boomers that are doing that wealth effect very well, if that makes sense. What's going to change?
I don't know the answer to that. I mean, I really don't know the answer to that, but I would suggest, as I say, that we find parallels in the 1967 and 1973 timeframe. Anyone who relies on conventional savings products will learn over the next 2 or 3 years that the money that they have in savings is worth less and less and less. My friend Jim Grant, famously calls the US 10-year Treasury return-free risk. If you think about the concept of return-free risk, it's not very attractive. Now, bonds have been a wonderful place to be for the last 40 years. They've been a fantastic place to be. When you cut the 10-year rate from 15.6 to 1.5, what you've done is you've increased the value of the principal on a yield basis 9-fold. It's been a spectacular bull market in so-called riskless assets, but people need to come to understand that that's over. I read the other day, Kerry, that the junk bond indexes, those are bonds issued by companies that have risky credits. The yield on the index of junk bonds is less than the CPI stated rate of inflation. The junk bonds are yielding under 5, and the depreciation of the currency is 6.5. In other words, people are lending money to dubious credits for a negative real rate of return. This can go on for a while, but it can't go on for too long. And interestingly, some of the recent weakness in gold in the United States has been due to the fact that the Fed has said that they're going to allow interest rates to rise, which has strengthened the US dollar. And I think that's going to happen.
I was going to say, Rick, here in Australia last week, Federal Reserve here in Australia, interest rates on hold yet again. This is the longest period of time we've had in Australia where there's been nothing. And it looks like that may continue because, and I pose this question to you, Rick, can governments, be they Australian or American governments, can they afford to raise interest rates with all this debt that they have? Or are they better off letting inflation run?
That's the $64 trillion question, Kerry. And again, I'll burden an Australian audience with American statistics. But traditionally, the US 10-year Treasury has had at least a nominal real yield. So if the CPI stated rate of inflation is 6.5%, if you take the 35-year mean, that would suggest that the interest on the US 10-year Treasury, the yield on the US 10-year Treasury should be 7. That would quadruple the interest charge paid by federal, state, and local governments in the United States. Could they do it? If you really want to tease yourself with something, in the US, and I know Australian property markets are hot, partly as a consequence of low interest rates. In the US, the 30-year mortgage rate traditionally has traded at a small premium to the US 10-year Treasury. So if you normalize the interest rates and you took the US 10-year Treasury from 1.5 or 1.6 to 7, and you took the first mortgage rate to a premium to that, say 7.5, if you raised the US 30-year fixed rate from 3.4 or whatever it is today to 7.5 or 8, that would have a major, major, major impact on the housing market. And finally, one of the reasons, at least in the US market, why equity prices are so strong is because the dividend yields on stocks relative to bonds and conventional savings products is high. If you double the interest rate payable on savings products, you devalue by half the capitalized value of dividends that people receive from their equities investments. So I would suggest to you that a meaningful increase in the interest rate is impossible as long as the deficits stay where they are, is impossible given the current status of federal, state, and local government debt, never mind the $14 trillion in consumer debt in the United States. Impossible because of its possible impact on the housing market, impossible because of its impact on consumer credit, in particular automobile sales, and impossible because of its impact on real estate prices.
So I go back to what I said, help us make more sense of what's going on. What are they going to be doing then? Because it almost feels to me, Rick, it's a balance beam and people are just trying to keep it steady by not raising those interest rates too much and not upsetting the ship at all.
I prefer to think about what I can do. I have no idea what they're going to do. I have no faith in them. And I suspect that if I offered up some policy prescriptions, they likely wouldn't listen anyway. From my experience, so I'm going to sound like a broken record to you, but that's okay. From my experience, times like these require people to own precious metals and precious metal securities. Now, I'm not saying that 100% of your net worth should be in these things. The lovely thing about precious metals is that when, lovely, I guess, when fear takes over in earnest, in other words, when normal people come to realize that their purchasing power is declining as rapidly as it is, precious metals prices tend to respond much more vigorously than most people believe they will. We've been conditioned to think about precious metals in the context of the last 20 years, as an example.
Mm-hmm.
But if you look at precious metals markets that I've lived through in my life, people say to me, well, Rick, the gold price is now 1,800 US dollars. I mean, up from 1,000. Can it go any higher? Have I missed the boat? My first bull market went from $35 to $850. What's that, 25-fold move, something like that? Yep. My second one was much more constrained, a very tame bull market from 2000 to 2011, where it went from $256 or something like that to $1,900.
Yeah.
If we have a circumstance where the government isn't able to normalize interest rates and isn't able to control their spending and continues to debase the currency the way they have now, if they lose the faith and confidence of savers like they did around the world in the early part of the decade of the 70s, that's an if. The gold price will surprise you. The silver price will surprise you, and it'll surprise you to the upside. The good news about that, Kerry, is that numerous studies have shown that a fairly small weighting in precious metals, 10 to 15%, can offset the damage that's done to 50 or 60% of your portfolio by the impact of increased interest rates on lower equities prices and lower bond prices. In other words, you don't have to have 100% of your portfolio in precious metals and precious metals related securities, 10 to 15%. And so when I say this is what you need to do, I can't tell you what your government's going to do. I can't tell you what my government's going to do other than something bad. But what I can think about is what I have to do. And what I have to do is insure myself against that collective stupidity called government.
And I love that collective stupidity called the government. And I tend to agree with you. Rick, you've been a very, very successful, you call yourself an investor and a speculator. I love that. And actually, you've occasionally called yourself a loan shark, which I find quite amusing. What is Rick doing at the moment? Because I think that I've said in the past, 2022 is going to be V for volatility, and that you do have to have some diversification. Now, this is the virtual gold conference, but Rick Rule is an expert in precious metals. We've spoken about the fact 10 to 15% there. Are you looking as well at other options out there? And are you looking at this potentially stock market having a bit of a pullback in 2022?
I am, Kerry, but I'm not counting on it. But you started off by talking about volatility. I'm looking forward to volatility. There's nothing in the world I like more than volatility, because despite the fact that my cash becomes worth less, I still maintain fairly high cash balances. I don't do that because I'm a masochist. I do it because having cash gives me the tools and the courage to take advantage of volatility rather than being taken advantage of by being taken advantage of. If you find a company that you think offers fair value at 10 Australian dollars, as an example, you've done the work on it, you've looked at the balance sheet, the income statement, all that kind of stuff. You like it, you buy some at $10 and it goes to $7. That's a good thing, not a bad thing. It means that something that you thought represented fair value at $10 can be bought at $7. So I'm equipping myself for volatility. In fact, I'm looking forward to volatility. I would urge all of your listeners to remember the great quote from Warren Buffett, where he said, you shouldn't buy a single share of a company if you aren't confident enough in its value that you wouldn't be delighted to see it fall 30 or 40% in price in the next 1 or 2 months so that you could buy more at a lower price. So I'm looking forward to volatility. Despite the fact that I see negative real yield on my cash savings, I maintain cash, although I believe gold and silver are good cash. I regard them as liquidity. I think, Kerry, that on a net present value basis, particularly the mid-tier producers in the gold and silver space offer the best relative value that I've seen in my career. The net present value of free cash flow, and this this extends to the Australian producers too. The net present value of free cash flows from developed reserves and resources at current commodity prices is the cheapest that I've seen in 45 years in the business. The relation between free cash flows and net present value in the producing equities relative to the gold price is the best I've seen it. And further, the market share that gold and silver enjoys in precious metals equities is the lowest it's been for 40 years. Most people don't know this, but less than 0.5% of savings and investment assets in the United States, at least, are precious metals and precious metals related securities. In the last 30 or 40 years, the median has been between 1.5% and 2%. So it won't take an enormous flow into precious metals, merely a reversion to mean, to double or triple or quadruple demand for precious metals and precious metals related equities. I'll leave it to the imagination of your listeners what would happen to precious metals prices and precious metals equities prices if we saw a tripling in demand.
Do you think that in the current, where we sit today, and I guess you could almost call it a malaise in precious metals, do you think that that is partly to do, I know you're not a big crypto focused person, but do you think potentially partly the malaise is due to the fact that a lot of this liquidity has flown into speculation in crypto and also tech stocks?
I think that the real challenge for the precious metals business has been the S&P 500 and to a different degree the tech stocks. Investors have come to believe that competitive companies with pricing power are relatively good inflation hedges. And I agree with that, frankly. I think Buffett proved that in the 1970s. The difficulty is that most of us who pick those stocks aren't Buffett, and you need to pick them very, very well. With regards to cryptos, I think maybe crypto has been a challenge for penny stocks, for highly speculative stocks, but it's worth noting that globally, it's alleged that there are 650 trillion US dollars in total savings and investment assets worldwide. The market capitalization of precious metals is about 10 trillion.
Wow.
The total market capitalization of crypto is about 8 trillion, which is to say that precious metals and crypto combined are a pimple on an elephant's behind. They don't matter. They actually don't matter. What matters is this, Kerry: institutional investors worldwide, the big endowments, the pension funds, the insurance companies, for 40 years have followed an investment mantra that said 60% of your assets should be in equities, 40% in debt. And these guys have an enormous problem because their bond holdings, that 40% of their portfolio, which is supposed to provide stability, guarantees them a loss. The biggest institutional investors worldwide have to figure out how to look after pensioners 20 years from now, how to fund universities 20 years from now, how to fund life insurance policies 20 years from now, where 40% of their portfolio absolutely, positively, without a doubt, guarantees a loss.
So
now,
what are they going to do, Rick?
Well, my supposition is that some of it has to go into precious metals. If you looked on the balance sheets and you looked at the asset statements of these same institutions in the 70s, the last time that we faced this circumstance, they were all long gold.
Is that right? Okay, because we've all got very short memories, Rick.
Sure.
And especially people, look, I'm not commenting on everyone listening, but I'm just saying the majority of people these days have short time frames and short memories and don't look back at history. Do you think history is repeating itself right now?
Absolutely. If it doesn't repeat, it rhymes. And remember, too, you don't have to go all in this narrative. Remember that I'm not suggesting that somebody take their portfolio to 100% gold. I'm just saying that they should be north of 0.5%. and I believe that's going to happen. It was estimated, I believe, by JP Morgan Chase that at the top of that epic precious metals bull market, that precious metals and precious metals related equities their market share relative to total savings and investment assets in the United States exceeded 5 or 6%. And I'm not talking about a return to that. I'm talking about a return to the statistical mean, which is to say 1.5 to 2%. And I think that's going to happen. It's interesting, too, that you talk about people's perception. Buffett, again, says that the market's seeming function is to transfer wealth from impatient people to patient people. It's odd. I am now 69 years of age. And it's odd that although I have less time on earth, I've become much more patient. When I was younger, I wanted my investments to have an impact on my lifestyle by the next long weekend. What I've learned is that real money is made in 5 and 6 and 7 year chunks. Well, I wish I could tell you exactly what's going to happen in 2022. I'm old enough and wise enough now to say I have no earthly idea really what's going to happen in the short term. Not Buffett this time, Munger. Munger says in the near term, the markets are a voting machine. They measure perception. In the long term, voters are a weighing machine. They measure what something is worth. Now, if you're comfortable with the way people vote, perhaps you can be comfortable with short-term thinking. I'm not particularly interested in the way people vote. I'm much more interested in how much things weigh. In other words, what they're worth. And I would urge your people who are impatient to ponder on whether you think the world owes them what they want, or whether or not they have to gear their perceptions to what it is that they can have. Because if it's the latter, which is what I think is true, patience isn't merely a virtue, it's a necessity.
Rick, I really appreciate that sort of that macro and that big look. And we've mainly been speaking about precious metals on the bullion side, the physical. But one of my favorite topics, I know one of your favorite topics, is the mining stocks. And later today, we are going to have presentations from a number of ASX listed gold, no silver this time, but a number of ASX listed gold mining companies here in Australia, but with assets all over, with a potential, and I do say potential because as I speak to you, gold seems to be holding above that 1800. Do you think that the big opportunities will be in companies with big deposits outside of Australia, or do you like Australia as a jurisdiction? Because I want to talk mining companies now, because that's where the leverage is.
Australia is my favorite jurisdiction in the world. You have unique advantages, mostly the rule of law, mostly a regulatory environment, and dare I say, a pool of voters who is at least familiar with mining. They may not like it, but they're familiar with it. You have a fantastic geological endowment, and importantly, relative to the size of your GDP, you have the best aggregation of intellectual capital in the mining business in the world. I'm not saying that there aren't other countries that might have more, but relative to the size of your economy and relative to the size of the capital markets, Australia has the best endowment of intellectual capital in the mining business on the planet. With regards to prospectivity, I think that probably most of the easy deposits that will be found in Australia have been found. And so for one opportunity is for the Australian companies to take advantage of mature Australian capital markets and Australian intellectual capital and look for precious metals or other materials in less politically mature jurisdictions where they could find bigger deposits. But the truth is that Australia is still, I think, the best jurisdiction in the world to find and own and operate a deposit. Not as good as it was 10 years ago, but no place is. Separately, the Australian producers, in a world where producers are historically cheap, are, I believe, statistically cheaper than their Canadian counterparts, despite the fact that I believe them to be better companies. If you are a true contrarian, and I suspect there won't be many at your conference, but if you're a true contrarian, the mining stocks, in fact, the resource stocks that you probably buy right now are Russian.
Oh, what?
They're Russian. They're the cheapest resource stocks on the planet statistically.
Oh.
They're well populated by tier one assets. The mid-levels of their management ranks, that is to say the younger people there, not the old commies like me, are first-class people. And the share prices have been driven lower by geopolitical tension. If war breaks out of the Ukraine, mark my words, they'll go lower still. But if you were looking at resource companies in isolation, if you looked at them at the quality of their assets and the price you paid for their assets, the interplay between the balance sheet and the income statement, most of your portfolio would be Russian.
Wow.
If you aren't willing to take that level of political risk, I would suggest that the best juxtaposition of political risk and reward on the planet is in Australia.
Well, that's good to hear. And I'm sure most of my presenters later today will be applauding Rick Rule's comment on that. If you were to have a balanced portfolio because I always say to people, investing in the gold mining, the silver mining companies, that gives you leverage to the price. But again, there's a balance there as well. What's Rick Rule's balance when it comes to producers, developers, and explorers?
I'm overweight the producers right now because they're so cheap. You know, one of the risks with the way that I invest as a contrarian is that I'm always early, Kerry, as you know. Mm-hmm. But with dividend yields at 5 and 6 and 7%, earned dividend yields at 5 and 6 or 7%, when my alternative is 50 basis points in a bank deposit,
going backwards, as you said,
it seems to me that the juxtaposition of risk to reward don't take this as a stock pick, but in a sort of an evolution or a name like that, it's very, very, very attractive. The junior producers, the West Africans, as an example of the world, are, I think, really, really attractive. I think that we're going to come into an exploration market, but I don't think that we'll come into an exploration market probably in 2022. I think we'll come into one in 2023 or 2024.
What do you mean by an exploration market? What do you mean by that?
A market where market leadership moves to exploration companies, the sort of market that you guys in Oz enjoyed in 2017, 2018.
Yep.
You know, where the sort of penny dreadfuls took leadership.
Yep.
I think we're going to come back into that kind of market. I don't think we're there yet. I think we're going to need leadership from the producers. And I think the producers are cheap enough that I'm overweight the producers relative to the juniors. My own preference, of course, is for the juniors. All the money that I now invest sensibly, I made speculating nonsensically in my youth. And I prefer nonsense to common sense, but we're in the market right now where common sense is much cheaper than nonsense. So I'm attracted to it.
Rick, there'll be some people listening today that are just understanding precious metals. They'll be saying, well, I haven't invested before into the equity side of it. What are 3 things that you would advise people when they're looking, because there's a plethora of the explorers out there. We know who the producers are. There's some developers. There's a lot of them on the ASX. What are the 3 things that Rick Rule looks for when allocating capital?
Your listeners will have to do some work around this. And I know work is a bad word usually, but value is the first thing I look for. I try roughly to calculate what I think the net present value of the free cash flow that the company will enjoy in the next 10 years from developed and developable reserves and resources. And I look at that sum against the enterprise value, which is the market capitalization minus the debt, adding back the cash. Mm-hmm. And I try to say, is this company worth what it's selling for? Or is it worth less than what it's selling for? The second thing that I look for is management competence. And you can't always tell that because there isn't always enough management continuity that their track record in the past is indicative of what they'll do in the future, because the people who created that track record are gone. But assuming there's management continuity, something called recycle ratio, which is the net present value of reserves and resources that can be created out of the unit of free cash flow today, If a company generates $1 in free cash flow, can they use that dollar to create $1.25 in value?
Right.
That's called recycle ratio. So recycle ratio is very, very important to me. And I personally look for something wrong that can be righted. Not so much in the great big companies, but let's say that a company had a bad quarter because there was a rainstorm, and the rainstorm, wrecked their pre-strip. Unless you assume that every quarter for the rest of their lives, they're going to have another rainstorm, this is a one-off event. And yet these rainstorms can cause 25 or 30% share price declines.
Yep.
A wonderful recent example of that occurred in Australia, where shares of a wonderful junior producer out there, West African Resources, sold off by 35 or 40% as a consequence of the coup.
That's right. Yep.
In Burkina Faso. Sadly, I've suffered through a lot of coups in my investing career, and they turn out mostly to be one-off events. The truth is that the gold in the ground is unconcerned about the stupid acts of the people on top of the ground. And what you learn over time, even in West Africa, is that the successor governments, like the governments before them, like the idea of the stable revenues that are provided by the mining industry. And just yesterday, I guess, the interim government of Burkina Faso reassured the world that it was an absolute top priority of theirs to continue to assist the mining industry in the development of Burkina Faso, and in fact, to step up the security arrangements provided by the government on behalf of the miners. And they made special reference to the fact that existing fiscal terms and conditions would be respected.
Wow.
So that's an example of a one-off that happened.
So what you're saying is, if people see something like that, not to focus on the headline news of, oh my gosh, there's been a tsunami or a coup or whatever it might be, but to look at the big picture, because people will sell off on the bad news, but that's not the full picture. Longer term thinking.
Exactly. Exactly. Think if the surprise, there is a North American silver producer called Gato, which had a release the other day that said that they'd miscalculated their reserves, and half of their reserves went to reserve heaven. That's permanent. If you have leverage on the balance sheet to build a mine, and half of the reserves, which were dedicated to amortizing that debt, went to reserve heaven, that's not a one-off.
No, that's a bye-bye. That's a bye-bye.
We'll see, but
or should I say that's a sell?
Yeah, you're looking for circumstances where you believe that the company is at least reasonably priced, if not cheap, where you trust the management team, and in particular, you look for something where there is an event that has caused the stock to sell off that isn't a repeating event. In my lifetime, those have been extraordinarily fortuitous circumstances.
Rick, we started this conversation by me asking you, help us make sense of what's going on. In the course of this discussion, we've had a wide-ranging chat about things to help us make sense of what's going on. You're a contrarian. Right now, I've heard you in the past say, I actually love it when the gold price isn't being focused on and it's a little bit flat, because that is the time when these are not your words, but people could back up the truck. Right now, where we're sitting, is this backing up the truck time, or is it have some exposure, but there are also other opportunities?
Well, there are certainly other opportunities, and I need to segregate myself from most of your audience. I've had some gold in my metaphorical truck for some substantial period of time. And so I might not need to take on the same amount of cargo as a beginning investor, but I'm certainly delighted to see the malaise in the gold price, because I'd like to buy more. I'm even more delighted to see the malaise in the price of the gold shares, because I'd like to own more. The truth is that I'm sanguine enough about the value that they present, that despite the fact that I have a fairly extensive portfolio in precious metals, I would much rather see the price go lower than higher, because I'd like to buy a lot more. At 69, I'm sort of hoping that I have 30 or 40 years of drawing breaths left. And for whatever strange reason, I'd like to have more money at the end than I do now. And that means that if there are investments that I think are attractive, I'd like to own more of them. In terms of things outside gold, you'll laugh, Kerry, at age 69, I and some partners are starting another bank.
What?
Yeah, it's the sort of thing I do in retirement.
Oh, do tell more, Mr. Rick Rawle. He's starting a bank, ladies and gentlemen. What is this all about?
I've done this before,
Okay.
and it's a very, very good business. It's one I like. I don't know anybody, when I ask them, are you satisfied with the service that your bank gives you, that says yes?
Absolutely not.
Nobody. I backed a group of guys in 1999, and they started something called Everbank, which was one of the first online banks in America.
Oh.
And these were wonderful people. They developed very innovative products, like savings products denominated outside US dollars, so people could save in other currencies. As an example, certificates of deposits that were denominated in gold indexes.
Wow. Okay.
They didn't have any bricks or mortars, and they grew that bank to I think it was $28 billion. Listed on the New York Stock Exchange, sold it to TIAA for $2.7 billion. It was a 30-to-1 shot for the early investors. Wow. And I'm backing the same team.
Same team.
Yeah, we're going to do it again. One of the things that we're going to do is we're going to lend money to people secured by their gold holdings. If they're holding their gold at Loomis or Brinks or some depository that we're comfortable with, we'll lend them money against their gold deposits. It seems to me that if I lend money against a liquid asset that I'm comfortable with, I've made a better credit decision than I would be buying a junk bond index, which yields below the rate of inflation. So, yep, I'm starting another bank.
Starting another bank backed by gold.
Yep.
There are others doing this as well, from what I understand. We've got Monetary Metals out there that are doing leasing arrangements. Rick, yep. Are you seeing that there might be a little bit of a movement away from that sort of what we have called in the past the counterfeiting of the funny money into loans against real money, which is silver and gold?
I don't know if there's a move towards it. I just know that that's an asset class that I like. It's an asset class that I know. It's an asset class that is underserved. There are probably 1 million Americans that save in gold, and they aren't served by the current financial system. Unlike the monetary metals people, as a consequence of being federally chartered, our balance sheet and income statement will be freely available. In other words, you'll understand a lot about your counterparty, something that we've chosen to do.
Okay.
But I don't think that in order for this bank to be successful, and by the way, we'll have other lines of business besides precious metals, but in order for this bank to be successful, the gold market doesn't have to grow. We just have to service the gold community, something that we've done in the past.
Fantastic. So when is this starting up? What's the name of it? How do people, if they wanted to, because there'll be people listening today, like myself, that have got physical gold that might want to say, oh, that sounds interesting.
Well, here, I'll make an offer to your attendees, Kerry, if I may.
Please do.
If you want to carry on a dialogue with me about natural resource investing or investing generally, go to a website, ruleinvestmentmedia.com. There, you can enter your natural resource portfolio. Please no pot stocks, please no tech stocks, please no crypto. I'll rank your natural resource stocks personally, 1 to 10, 1 being best, 10 being worst. And I'll comment on those issues where I think my comments might have value. If you are interested in my bank, in the question line, write in bank. Also, I have a new feature, free so far, but I may charge for it someday, where I'm maintaining a list of investors who are accredited investors, people who are able to participate in private placements. I don't charge anything for this. I don't get any fees from the companies, totally free, but it might become a subscription feature in the future, where I give notice to everybody on the list for every private placement that I do. Not every one I'm shown, just every one I write a check on. It's totally free.
Wow.
If you're an accredited investor, I do a lot of Australian placements, by the way.
Wow.
If you're an accredited investor and you want to see what I'm doing with my own money, write down placements. Finally, if you are interested in uranium and you're a speculator and you're not interested in uranium, you're crazy.
Yeah.
So with that caveat, if you're interested in uranium, remember the prices have fallen, the stocks have fallen by 40% in 6 months. They're on sale. If you're interested in uranium, we're doing a Uranium Investors Boot Camp, 6 hours online. So if you're interested in information about the boot camp, in the question line at ruleinvestmentmedia.com, write boot camp.
I put down uranium. Don't put down uranium, ladies and gentlemen. Put down boot camp.
Uranium or boot camp, it doesn't matter. It's $99 US to attend. If you don't think you got your money's worth, tell me by email. I'll give you your $99 back. Absolute money back guarantee.
All right. So there we have
rankings, bank, placements, boot camp.
Yeah. Rankings, bank, placement, boot camps. You know, Rick, you always give so much value to our audience. And I really deeply, my gratitude is very deep for that because, you know, as you say, one of the things about you is you love to help other people. You've done extremely well yourself, and sharing your knowledge to me has always been, you do it with such graciousness, and I'm very grateful for that. I'm going to throw over to you for the last word, as I always do. It's a wonderful audience that we have out here. What's your last word to our investing audience about gold, precious metals, and going forward?
Well, it sounds simple, but own some. The fact that the wind is in the sails of precious metals, while it may be unfortunate for other aspects of your portfolio, is fortunate in terms of taking advantage of it. Don't go overboard. Don't own 100% in any asset class other than perhaps your own business, but own it. Own the metal itself. I consider mine to be liquidity, volatile, but good liquidity. Treat volatility, treat bear markets as sales. Think of them as good things. And consider certainly owning the mid-cap and large cap gold producers, the ones that are yielding 5 or 6 or 7% from free cash flow. This is, from my point in time, the most attractive range of equity valuations that I've seen in 45 years. Doesn't mean they can't get cheaper. But when I juxtapose the potential downside to the potential upside, they seem very, very attractive to me. Could they have a 20% downside, 25% downside? Sure. Could they, in the course of the next 5 years, be up 400 or 500%? Sure. I'm not saying they will be, but if you look at a circumstance where you have 20 or 30% downside, you have 200 or 300 or 400% upside, it seems to me like the arithmetic, the juxtaposition of risk to reward, is pretty attractive.
What a great way to finish up our conversation today. Now, ladies and gentlemen, you heard it before. He's given out his email address, rick@ruleinvestmentmedia.com. Please, no pot stocks, no TED stocks. Yes, Rick.
And for the rankings, don't do the Rick part. Just go to ruleinvestmentmedia.com to find out.
Yes.
Yeah. Okay. Yeah.
Yeah. So ruleinvestmentmedia.com
Yep.
/rankings, isn't it?
Nope. Just ruleinvestmentmedia.com. That's all you need.
That's all you need, and it comes straight up.
Yep.
Oh, fantastic. All right. And don't forget to put in there as well all those words. What were the first one was?
Bank.
No.
Well,
rankings, bank, placements, boot camp.
Yep.
Fantastic. Thank you so much, Rick. As always, great to see you. And thank you for opening the Virtual Gold Conference 2022.
Always a pleasure. I hope all your attendees enjoy the event, and I hope you come out of it living, at least.
Yeah, well, I think most people know I am suffering a little bit from COVID, so the voice is a bit croaky, but we will continue with our day, and we wish you all the best as well. Thanks, Rick.
Great, Kerry. Thank you.